Okay. All right. Please, can we see the screen? Are we able to see the screen?
Yes.
Okay, very good. Yes. So I'm sure some of us have come across the standard IA 36 impairment of assets. All right. So this standard regulates the the accounting treatment of assets that are impaired. How do we handle assets that are impaired? But even before we even go deeper, we need to understand we need to understand the meaning of impairment. So when we say impairment in in English, what are we referring to? So when we say impairment, we are talking about the loss in value of an item. Okay, so an item that is impaired means that item has lost part of its value or it is not functioning as expected. Yeah, so that is the meaning of impairment in English. So when we translate it to accounting, specifically impairment of assets, we are talking about assets that are operating below capacity or assets that have lost part of its value. All right. Yeah. So that's what it
I
means.
think you are breaking a lot.
Hello. Hi. Hello. Can you hear me?
Yeah,
Okay. I
it's
thought
better now.
you were saying something. Okay. Okay. It's better now. Okay. Good. All right. So when we say an asset is impaired, we mean the asset has lost part of its value or is no longer functioning as expected. And impairments can happen when probably the asset is damaged. There's a physical damage to the asset. Okay, or maybe the asset has developed a fault, or maybe there's a market condition that has affected the value of the asset. You know, yeah. So there are different kinds of conditions that can affect the value of an asset. So when an asset is impaired, we need to so first of all we need to examine the asset to be sure whether it is impaired. Okay, so you need to do impairment review. Okay, go you have to check whether the asset is impaired or not. If you're able to determine the asset is impaired, we need to know how much the asset has been impaired. Okay, so how much value has the asset lost? They get it. So that loss in value is what we call impairment loss. All right. So the impairment loss is the loss in value. So if an asset value is 2,000 and per our impairment test, we realize that the asset value is now 1,800. So there's a difference of 200, which is what impairment loss. Okay. Now this standard does not apply to all assets. It mostly applies to non-current assets like tangible assets. Okay, this standard does not apply to inventory. Okay, even inventory is an asset, but it doesn't apply to inventory. It doesn't apply to assets held for sale. Okay, non-current assets held for sale. So if you have a non-current asset and you intend to sell it, this standard does not apply to such assets. Okay, this standard also does not apply to financial assets. Okay, it doesn't apply to financial assets. Financial assets has its own um, standard for the treatment of impairments of financial assets. Okay, and this standard does not also it does not apply to what's the name assets arising from employee benefits. Assets arising from employee benefits. Okay, so clearly this standard mostly affects tangible assets like physical assets we can hold and touch. Okay, but for all the other assets, this standard, and it doesn't also apply to investment property. This standard does not apply to investment property. Okay, yeah. Okay, so that's just an introduction. Yeah. So when we say impairment, we are talking about a permanent loss in value of an asset. So you can see here there's this machine which is clearly damaged. You know, it is old, it's damaged, it's clearly has lost some value. You know, so we can say this machine is impaired. You know, and what are the indications of impairment? All right, so these are the indications of impairment. Physical damage to an asset. If an asset is physically damaged, we can see maybe there's a broken part, there's a broken yeah, there's a broken part, there's a broken component. We can clearly say that the asset is impaired. Okay, number two, the economic performance of the assets is worse than expected. So if the asset is not performing to standard, it's not performing as we expect, we can say the asset is impaired. So for instance, when we take production manufacturing plants, you know, manufacturing plants are expected to produce certain units per hour or per day or per month. Okay. So if the asset is not able to produce that quantities we are looking at per is not able to produce the quantity we are looking at, then we can say the asset there's a problem with the asset and it means the asset is impaired. Okay. Number three. The asset has the asset value has declined significantly during the year. The asset value has declined significantly. Okay, so significant decline in the value of an asset. Okay, significant decline in the value of an asset. If the asset value has reduced dramatically on the market, we can say the asset is impaired. The next one, there's there's reduction in the asset's useful life. So if the assets has lost part of its useful life, we can say the asset is impaired. Let's say the asset originally had useful life of 5 years. So this is the original useful life. But after using it for 1 year, we realized this asset cannot operate for 5 years, and probably we can only use it for 3 years. Yeah. So which means the asset's useful life has reduced. All right, indicating that there's an impairment. Okay, so these are signs of impairment. So when you see these signs, then you go ahead to perform an impairment test on the asset to determine its what we call recoverable amount. All right. So if you suspect an asset is impaired, then you have to determine the asset what recoverable amount. Yeah, so this is an important term under IAS 36. This term is one of the key terms under IAS 36. Recoverable amount. Recover is so you see it's coming from the word recover. What's the meaning of recover? Anyone to help us? To recover means to do what? Can anyone help us? Recover.
It means the proceed we get. Should we sell the asset?
Yes, yeah. So recover means, I mean, what you can get out of something. Okay, to recover. Yeah. So recoverable amount is what is the value we will get, assuming we try to, uh, or I mean, what are we going to get out of the assets in terms of the value we will get? Okay, so the recoverable amount is the value we'll get from the assets. And what are the ways we can get value from an asset? If you have an asset, how can you derive its value? How can you derive the value from an asset? Anyone to help us? Let's say you have a vehicle, you have a car. How do you get its benefits? How do you benefit from the vehicle, or how do you take out the benefits out of the vehicle? Mm. Anyone to help? You have a you have a car. Okay, this car is an asset. How can you get the benefits out of this car?
Who its usage?
Anyone to help? Yeah, there are two ways. There are two ways of benefits from this car. Okay, so I'll mention one, and then you try to also add the one. Number one is you can use it. As you are using it, you are benefit from it. You know, you can use it to move about. I mean, to move around, to use it to drive to work, drive to school, drive to your home, your house, drive to the market. You know, that's the benefit you are getting. So you can use it to get the benefit out of the assets. Okay, so what else can you also do to get the benefit out of this asset, out of this car?
By selling it.
To
uh
generate income.
You can also decide to sell it. uh Yeah, if you don't want to use it, you can sell it, and you can also benefit from it. Okay, use and sell. Okay, now if assuming that we can if we can quantify the benefit we derive from using it. So let's say if we use it, we can in monetary terms the benefits we will get. Let's say we'll get benefits of maybe 30,000, and if we sell it, we will get benefits of 60,000. So which one will you choose? Will you use or sell? Hello.
Sell it.
Okay, why? So you want to sell? Okay. So why do you want us to sell?
But I'll gain more from the sale as
Yeah.
compared to using.
Yeah. So when we sell, we will gain more than to use. Okay, what about if to use it we will get maybe 70,000, but when we sell it we'll get 60,000? Which one will we use? Which one will we choose? Will we go for? So clearly we'll choose to use it. So always we want the maximum benefit from the assets. So if the maximum benefit is from using it, then we'll use it. If the maximum benefit is selling it, then we will sell it. So according to the standard, the recoverable amount is not one figure. Okay, so to determine the recoverable amount, you you need to know how much you get if you use it and how much you get if you sell it. Then you compare the two and pick the one with the greater benefits. Do you get it? So according to the standard, the recoverable amount is the higher of what's the name? Is the higher of fair value less cost to sell. Okay. Fair value is, let's say, the market value of the assets, and the cost to sell is selling cost. If you want to sell an asset, sometimes you have to incur some cost, maybe advertisements. You need to advertise. Maybe you are selling your property. You have to place it in the newspaper, or you need to make sure people are aware of what you are selling. So you have to incur some incremental cost or some direct cost. Okay. So fair value less cost to sell, and then we call this value in use. Okay, value in use is the benefit we derive from using the assets. Okay, value in use. So the standard says that the recoverable amount is the higher of the fair value less cost to sell and value in use. Okay, the value in use is how much benefit you derive from using the assets. And the fair value less cost to sell is the benefits from selling the assets. Okay. So that's a recoverable amount. So let's look at very simple example. We have a vehicle. Okay. This very vehicle has a carrying amount. A carrying amount means the amount it shows in our books. It has a carrying amount of 500,000. Okay, 500,000. All right. But if we sell it, s- if we sell it, okay, if you decide to sell it, so that's the fair value less cost to sell. If you sell it, we'll get maybe 380,000. Okay. If we continue to use it, okay, that's the value in use. If we decide to use it, we are going to get three 330,000. Okay. Now we have this information. Now the first question you have to ask yourself is this asset impaired or not? Okay, before that we need to know when an asset is impaired. Okay. An asset is impaired when its carrying amount, the whatever is showing in the books, is higher than its recoverable amount. So an asset is impaired if the carrying amount is greater than the recoverable amount. Okay. All right. So if I have a vehicle, the carrying amount is showing 300,000, but if I decide to sell it, I will get 380,000. If I decide to use it, I will get 330,000. So what it means is that this value here is not the true picture of the value of the asset. Okay, because the carrying amount of an asset is the benefits we will derive from the asset. So this 500,000 means that this is the benefit we will get from the assets. But if we decide to sell the asset, we are getting 380,000. If we decide to use the asset, we are getting, so the benefit is less than what we have stated here. Do you get it? Which means this figure is not correct. Like, I mean, the benefit is less than what we have stated as the current amount. Okay, so whenever the benefit we are going to get is less than the whatever figure we have put as the current amount of the asset, it means the asset is impaired. Okay, so that is how we determine whether an asset is impaired or not. Okay, so with this explanation, what do you think? Has the assets been impaired or not? Hello, can you hear me?
Hi. Yeah, we can hear you.
Okay, yes. So looking at this illustration, what is your view on this asset? Has it been impaired or it's
Okay, since the carry amount is bigger than the recovery amount, it is impaired.
Mhm. Okay, good. So we can see that the current amount is more than the recoverable amount. Okay. And what is the recoverable amount based on the figures here? Which one is the recoverable amount?
Okay. What is three?
Hello? It's how much?
Hi. So that would the 380,000.
Correct. Yeah, so those are recoverable amounts. Yes. Good. So, yes. So you can see the current amount is more than the recoverable amount. So it means we have an impairment. So carrying amount 500,000, recoverable amounts 380,000. So how much is the impairment? It's 120,000. So there's impairment loss. Okay. Okay. So how do we treat this loss? So this loss is an expense. Okay, it's a loss to the company. So this figure is recognized in the profit or loss as an impairment loss. Do you get it? But if the asset is carried a revalued amount, you know, so it is an impairment loss if this asset is measured using the cost model. Okay. But if you are using the revaluation model, Okay. If we are using a revaluation model, then it becomes revaluation loss. Do you get it? So let me. So it is revaluation loss if we are using the revaluation model. I hope we are clear with that. Hi.
I
Okay, I hope we are clear with
Yes.
this.
Yeah.
Okay, good. All right, so let's continue. Um, okay, now let's look at the value in use. Now we mentioned that value in use is the value we get from using the assets. Okay, so let's say we are we have year one, year two, year three, year four. Okay, now we are standing here. Okay, all right. Now we intend to use the asset for 1, 2, 3 years. Okay. Now each year, this asset will generate some cash flows to us. Each year, when we use the asset is going to generate some future cash flows. So let's say this year will generate 10,000. This one is 10,000. So when we say value in use is an estimate. You have an asset. There's no way you can be sure that okay, when I use this asset, I'm going to get this value. I mean, this definite value. It is an estimate, and it is based on your forecast, your future forecast, your future benefits you expect to derive from the asset. Okay, so since the the value in use is based on future forecast, future cash flows. So we need when we are determining the value in use, we need to find the present value of the future cash flows. Okay, all these are in the future, but we are standing at year zero. Okay, to estimate the value in use, we need to find the present values of all the future cash flows. Do you get it? Yes. So value in use is the present value of future cash flows that is expected to be generated from the assets. You know, yeah. So that is the formal definition of value in use. Is the present value of the future cash flows expected to expected to be derived from the use of an asset. Okay. So usually you'll be given a discount factor. Okay. When you are calculating value in use, they will give you a discount factor, maybe 8%, 10%. So this is what you use to determine the present values of all the future cash flows. All right. So let's look at an example. A company estimates that an asset is expected to generate the following cash flows over its useful life of 4 years. Okay. Year one, 75,000. So this is the inflows and outflows. So as you are using the assets, definitely you also spend on it how the asset is giving you, bringing in cash inflows, you also spend in the form of repairs, maintenance, so there will be cash outflows. So we are interested in the net cash flow, the inflow minus the outflow. Okay, that's what we are looking at. So year one, inflow 75,000, outflow 6,000. Year two, year three. Okay, so let's look continue with the question. All cash flows will occur at the end of the year concerned. At the end of the 4-year period, the asset is expected to be sold for 50,000. Assuming a discount rate of 12%, calculate the asset value in use. Okay, so we have to calculate the asset value in use. The asset value in use is the present value of all the future cash flows from the assets. So we need to know all the net cash flows for each year. Then we will determine the present values. So let's see how we can go about it. So we have the year. So year two, year three, year four. Okay. Then let's look at the cash inflow, then the cash outflow, then the net cash flow. Okay. So for year one, the cash inflow is 75,000, outflow is 6,000. So 75 6. So the net cash flow is the inflow minus the outflow. Okay, let's look at year two. 107. So 107. Year three. 97. So 97. Year four. 66. Okay, so these are the net cash flows. Then we have to find the discount factor. Okay. So we were told that the discount rate is 12%. Okay, so year one, the discount will be 1 over 1 plus 12%. Okay, raise the power 1. Year one, so it's raise the power 1. Year two, it will be 1 over 1 plus 12%. Raise the power 2, in that order. So this will be raise the power 3. This will be raise the power 4. Okay. So now we need to find the net present value. Sorry, the present value. So the present value is equal to the cash flow, the net cash flow multiplied by the discount factor. Okay, so these are the net cash flows. So when you finish, you add all the present values. You know, yeah. So this is the present value of all the future cash flows. So this becomes the value in use. All right, but there's something we missed here. Says that at the end of the 4 year period, the asset is expected to be sold for 50,000. So when we sell the asset, it will also give us some benefits. That we can sell it at the end of the 4 year period. Okay, so when we need to come back to our workings. Okay, so year four, we have decided to sell the asset. So if we sell it, we'll get an inflow of 50,000. That's so 50. So the same discount factor. Okay. So this is called the value in use. Okay. What we have calculated here is called the value in use. All right. Can we continue? Are we good to go?
Yeah.
Okay. Yeah. So this is how we calculate value in use. So in exams, if you are asked to calculate value in use, this is how we go about it. Okay. So let's continue.
I have a question.
All right.
Okay, so as me, you are giving a question, and in that same question, there was no cash outflow. It means you go ahead using the cash inflow with the discount factor and
Yes,
work
yes,
straight away.
yes. In case there's no outflow, then you use only the inflow. Yeah.
Okay, thank you.
Okay. You're welcome. Okay. Okay. Now let's look at impairment of intangible assets. All right. So we have not done intangible assets yet, but let's talk about it a little briefly on about it. So an intangible asset is an asset without a physical substance. It's an asset we cannot touch, but yes, though it's an asset. Like for instance, a license. If you have a, let's say, a mining license, you know it is an asset because it allows you to engage in mining. Okay, if you have maybe a patent, a copyright, these are trademarks. And these are what's the name, they are not tangible assets. It's not an asset you can touch, like a vehicle or machine. But they are also very important because they they are able to generate future benefits. Like if you have a very strong name, a brand name, the name can be an asset. Like for instance, KFC. The name is, I mean, it's known, it's valuable. So some people purchase the name. They build they set up the branch, the KFC branch, and they use the name, they buy the name. Okay. Yeah, they buy the name and brand the branch as KFC branch. You know, so intangible assets are assets that we cannot touch, but they are also they generate benefit to us. Yeah. So when it comes to impairment of intangible assets, we have intangible assets with useful with an with a definite useful life, and we also have intangible assets with no useful life, like with indefinite useful life. Okay, it means that assets can be used forever. But there are also intangible assets that can only be used for the period you purchased it. Maybe if you buy a software for 2 years, to use it for 2 years, then the useful life of the software is 2 years. But there are some intangible assets with no expiry dates. In that case, we call that indefinite useful life. So if you have an intangible asset with an indefinite useful life, the standard says every year you have to test for impairment. Now the question is, why is the standard saying that if you have an intangible asset with an indefinite useful life, you have to test for impairments every year? uh So if the intangible assets has indefinite useful life, you are saying that this asset will bring us benefit forever and ever. Every year we'll benefit from the assets every year. So you have to be sure each year whether what you are saying is true or not. Okay, so that is why the standard says you have to test for impairment of such assets every year. Because if you say the asset has indefinite useful life, you mean that this asset can provide us benefits to perpetuity, forever and ever. So every year you have to test whether this assertion is true or not. That is why intangible assets with indefinite useful life is tested for impairment every period. Okay. But for other assets, it's not compulsory to test for impairment every at the end of each period. Okay. So for instance, if you just did impairment last year, you tested the asset for impairment just last year, and in this year, I mean, nothing really has changed. The conditions of the asset has not changed. There's no need to perform impairment test on it, on the asset. Okay. Yeah. So let's look at conditions when impairment test is not necessary for intangible assets. So what are the conditions that will allow us not to test for impairment? Okay, number one, if the asset does not generate independent cash flows. Okay, if you have an asset, okay, you have an asset. This asset does not generate independent cash flow. Okay, does not. If we say does not generate independent cash flow, we mean that there are some assets that you can use on its own to generate or to generate revenue. So for instance, if you had a truck, if you own a truck, okay, if you have a truck, the truck you can use it for, I mean, transport transporting goods and all that. And you can what is the name? You can You can generate the track can generate benefit for you directly, because you can use it to generate income. But there are some assets that they cannot generate income on their own. You have to use the assets with other assets. So, for instance, if you have furniture, you have furniture in the office. I mean, furniture cannot generate any cash flow to you. Okay, but they are all parts of the assets you have that, I mean, make operations go on smoothly. But if you take furniture alone, these assets cannot generate any benefit. Like, it cannot generate cash to you. Do you get it? So if you have an asset and the asset is like a furniture, okay, it does not generate independent cash flows, then you don't need to test for impairment. Or if you want to test for impairment, then you have to group, you have to test for impairment on the for all the assets that this asset belongs. Okay. So maybe this asset, it, it belongs to furniture, it belongs to a group of assets with these items, maybe furniture, computers, maybe equipment. Okay, so all these assets work together to generate some benefits. These assets are able to work together to generate cash flows. In that case, if this assets you cannot you cannot allocate, or you cannot track any cash inflow coming from this asset, then you have to group this asset into a class of assets which is able to generate cash flows. Then you will test for impairment for all the assets in that class. So let me take it again. So there are some assets that can generate cash flows on their own. Example, if you have a delivery truck, you can use it to deliver goods here and there, convey goods, materials. You know, you can you can trace the cash flows. But there are also assets like office equipment and the rest of them. Those ones, they do not generate independent cash flow. They work together. You know, they work together in a group to be able to generate cash flows. So since they work together and they don't generate independent cash flows, when you are testing for impairment, you don't test them individually, but you select the whole class and test the impairment for as a whole, as a class. Okay, we call this class cash generating unit. Cash generating unit. All right. Yeah, so that's what it means. Okay. So if the asset does not generate independent cash flow, you don't test for impairment. If you want to test for impairment, then you should test for impairment for the whole class of assets that asset belongs. Okay, number two, the most recent recoverable amount exceeded the current amount by a substantial margin. So if you have recently done an impairment test and you notice that the recoverable amount is higher than the current amount, it's far higher than the current amount, it means there's no impairment because the recoverable amount is higher. Okay, and you did that test, let's say last year, So last year you did the impairment test. The recoverable amount maybe was 200,000, but the current amount was maybe 70,000. So you can see the recoverable amount is far higher than the current amount. Okay, and then this year, okay, this year too, you want to test for impairment. But last year when you did the impairment test, you notice that the recoverable amount is very very high. So it is unlikely that, I mean, this recoverable amount will fall all the way below the current amount. And so that's what the standard is saying, that if you did a recent impairment test and you notice that the current amount is far higher than the recoverable amount is far higher than the current amount, you don't need to perform an impairment test in maybe in the next year or in the short term. Okay, even if you do, maybe you have to wait for some time for conditions to change before you can test for impairment. Because testing for impairment also comes with cost, because you need professionals to come and look at the assets, value it. That's also costly. Yeah, yeah. So that is how that is how we go about it when we are dealing with testing for impairments. Okay, let's look at cash generating units. So I've already explained this concept. This is cash generating unit refers to a group of assets that work together to generate cash flows. Uh, it's a group of assets that work together to generate cash flows. Like if you take the human body, we have the leg, the hands, the the head. We have different parts of the body, but they all work together for they all work together to allow the person to move, to live, to do whatever the person wants to do. All right. Yes, but the head alone cannot do anything. The hands alone too cannot do anything. But they must all work together to achieve a common objective. Yeah. So when we say cash generating units, we are referring to group of assets that work together to generate cash flows. Yes. So it is possible that a cash generating unit can also be impaired. Okay. All these assets can be impaired. Now, if since they are a group, since they are a group of assets, a number of assets come together. If there's an impairment, how do we know? Okay, it is for this asset. This asset is impaired. Okay, it's for this, not this. How are we able to? So what we do is when there's an impairment, we the impairment loss is shared among all the assets. Okay, the impairment loss is shared among all the members in the group. Do you get it? But even though they are shared among the members, there's a hierarchy, or there's a procedure we follow when we are sharing the impairment loss. Okay, so the first item to be affected, or the first asset to be affected, is goodwill. If you have any goodwill in this asset, okay, it the impairments will affect goodwill first, then followed by if there's any asset that you can clearly see that it is damaged, or you can see that the asset that is causing the problem, then we will also um consider that. So asset damage. Then number three. Now, if there's any balance of the impairment loss left, the rest it will be shared among the remainder of the assets. Okay, that is how we do allocation of impairment loss. So an example will help us to understand how this works. Okay. Now let's look at an important um, issue. Now let's say that we have we have a cash generating unit. Okay, these are the members. So we have goodwill. The current amount of the goodwill is 20,000. We have vehicle. The current amount is 25,000. We have equipment. The equipment, okay. The fair value. The fair value. So this one is current amount. Current amount. But this one is the fair value. The fair value, let's cost to sell. Maybe the fair value is 28,000. Okay. So when we add this whole asset together, how much are we getting? 20 plus 25,000 plus 28,000. Hello, can you hear me? Hi, hello, hello.
Hi.
Okay, so can you do this math for me? 20,000 plus 25 plus 28. So how much are we getting? Okay, so we have 20,000 plus 25,000 plus 28,000. So this will give us 73,000. So this is the current amount of this cash generating unit. Now we are told that okay, this cash generating unit has been impaired, and now the new current amount is let me say 65,000. So this is the new current amount, or this is the recoverable amount. Sorry. So this is the recoverable amount. So there's an impairment of how much? 73,000 minus 65,000.
8,000.
There's an impairment of 8,000. Okay, okay. This illustration, let me reduce this further. Maybe this is 40,000. Okay, the recoverable amount is 40,000. So there's an impairment of how much? 73,000 minus 40,000.
33,000.
Okay, 33,000. Yes. So this is the impairment loss. So now this impairment loss, we have to share the loss among these assets. And we have to allocate this loss to the assets, to the individual assets. Okay, so the standard says that the first to be affected is goodwill. So 33,000, we will use 20,000 to write off the goodwill. Okay, so that goodwill will be zero. Okay, new balance. Its goodwill will be zero. Now, after taking the 20,000, how much will be left? It will be left with 13,000, isn't it? The impairment loss will be left with 13,000. Now, the 13,000 will be shared between these two assets. We are going to allocate between these two. Okay. Now, the standard says that, okay, if an asset, if any of the asset has a fair value, okay, has a stated fair value, we cannot allocate impairment loss to that asset. Do you get it? We cannot allocate an impairment loss to we cannot allocate an impairment loss side that the allocation of the impairment loss will cause the assets, the carrying amount, to be less than the fair value. Do you get it? So the equipment has a fair value of 28,000. It means we cannot go below 28,000. Okay. So it means the rest of the impairment loss has to be allocated to the motor vehicle. Okay, which is the 13,000. Do you get it? Because this one has a restriction. This one has a restriction that we should not allocate any impairment loss that will cause the new carrying amount to be below the fair value. Do you get it? So this one, the new carrying amount will be 25,000 minus 13,000. So 25,000 minus 13,000. So this will be 12,000. Okay. Yeah. So this is a restriction on allocation of impairment loss. Okay, let's do another example to help with our understanding. Okay, let's look at this. The current amount of assets of a car generating unit are as follows: goodwill 200, development cost 300, property, plant and equipment 600. The recoverable amount of this car generating unit is only 780,000. The fair value less cost to sell of the property, plant and equipment is 500,000. Okay. So they are saying that the fair value less cost to sell of the property, plant and equipment is 500,000. It means that they have given us a restriction on the property. Okay, to what to 500,000. It means we cannot allocate impairment loss that will cause the carrying amount to be less than the 500,000. Do you get it? A. Calculate the amount of impairment loss and show how this should be allocated between the assets of the cash generating unit. Let me take it again. Calculate the amount of impairment loss and show how this should be allocated between the assets of the cash generating unit. Okay, so let's go back to our board. So these are the assets. Goodwill. Goodwill has a current amount of 200. Development cost 300. PPE 600. So when you add everything, you are getting 1,100. Now we are told that the recoverable amount is 780. Okay. So what is the impairment? 1,100 minus
It's
780.
320.
Okay, 320. 320. Good. Now we have to share this 320 among the assets. So this is the old carrying amount. Okay. Then we'll do our allocation. Then the new carrying amount. The new carrying amount. Okay. Now 320, we will use 200 to cancel the goodwill. Okay. So now goodwill will be zero. So how much will be left? 120. Is it?
120.
So now this 120 we will share it among the two. Okay. So we have to find the total of these two. 300 plus 600 is 900. Okay. So the allocation for 300 will be 300. Sorry, the allocation for the development cost will be 300 over 900 multiplied by 120. Okay. So how much will we get? 300 over 900.
40.
Okay, this will be 40. Then the PPE will be 600 over 900 times 120.
Uh,
Okay, 600 over 900 times 120. That will be 80, isn't it?
yes, please.
So this will be 260. 300 minus 40 is 260. 600 minus 80 is
520.
520. Uh, all right. Now there was a restriction on the PPE. They said the PPE should not be below 500,000. Okay. But we can see that this is above, so it means it's fine. It's okay. Okay. Yeah. Okay, let's continue with the question. Two, explain how the allocation of the impairment loss would change if the fair values less cost of disposal of the property, plant and equipment were 550,000. Now they are saying that instead of the 500,000, what are we going to do if the fair value of the property is 550? It means that in that case, it means that we can only allocate um when we allocated the 200 to the goodwill, we're left with 120, isn't it? And now they are saying that goodwill should be limited to 550. The new goodwill should be limited to what? 550. Mhm. So it means when we are allocating, we have to ensure that we don't allocate impairments that will cause PPE to be below the 550. The new PPE carrying amount to below the 550. Okay, so let's see how we go about it. Okay, so the goodwill is correct. Now we have 120. Okay, this one will take how much was it? Was it 60? I think it was
It was 40,
uh,
40, 80.
okay, yeah, it was 40 80. This one was 40. This one was 80. Now, if we allocate 80 to the 600 to the PPE, we are going to get 520, which is less than the what's the name? The restriction. So you mean we cannot allocate all the 80 to what's the name? The PPE. So how much can we allocate? We can only allocate what's the name? We can only allocate 500. Hey, we can only allocate 50, isn't it? Instead of 80,
Yes, please.
we can only allocate 50. Uh,
Let's
so
see.
so this will become 50. So that we'll get here 550. 550. So it means that what the balance will go to the development cost. So it means that the development cost will be 40 plus
Plus 30.
the 30. Uh, the one that we couldn't, the balance that we couldn't allocate to the PP. So that will be 70. Like this. Do you get it? So this will be two 230, right? Mm, yeah. So that is how it is. So in exams, when they give you a restriction, when they tell you that one of the assets has a fair value of a certain amount, then when you are doing the allocation, you have to make sure the allocation does not cause the new carrying amount to be below what they have stated. So if anything, it should be the same as what they have stated. It should not go below that. You get it? Yeah. So let's note it very well. Now let's look at reversal of impairment loss. Reversal of impairment loss. Okay. Okay. An asset can be impaired this year, but the following year maybe things might change and the asset may start performing well. So that's what we call reversal. So we have impaired the asset. The next year, the asset is performing creditably. In that case, we have to what reverse the impairment loss that we we charge to the asset. So let's look at an example. We have first year. In the first year, we have an asset. It had a carrying amount of 2,000, but the recoverable amount was 1,005. So there was an impairment of 500. Okay, that's the first year. Then we come to second year. Second year, the current amount of this asset. Okay, second year we did an impairment test, and we noticed that this asset has improved in performance. Okay, has improved in performance. Therefore, we have to reverse the impairment loss that we have charged in the previous year. Okay, so in that case, okay, I think let me do this thing very well. Okay, so first year. Okay, so the current amount is 2,000. Recoverable amount is 1,500. And the useful life of this asset is okay. The cost of this asset is maybe 5,000, and the useful life is 5 years. Okay, no, let me say. Okay, let me say. Uh, okay, okay, 5,000. Is it okay? So the cost is let me say 6,000. Useful life is maybe 3 years. So it means that every year depreciation is 2,000. Depreciation
2000.
for the year is 2,000. Okay. So we did the impairment loss. We got a recoverable amount of 1,005. So the impairment loss will be 500. Okay. So the new current amount of this asset is 1,005. Right. So we come to the second year. Second year, so we are going to depreciate this um the current amount, the opening balance. Okay, was 1,005. Then the depreciation charge. Hey, am I charging more depreciation? No. No, 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 no. Okay, okay. I think I have to use more. So cost 6,000. Useful life 3 years. Okay, so first year carrying amount 4,000. Recoverable amount 3,500. Impairment 500. So we come to the second year. Okay. So this will be the new carrying amount as the opening balance for the second year. So carrying amount 3,500. The opening balance. Depreciation. Depreciation charge is 2,000. Yeah. So our carrying amount will be 1,500. Okay. Now let's say we did an impairment test and we noticed that the recoverable amount. Okay. Maybe the recoverable amount is now um let me see. Uh okay, okay. So the recoverable amount is 2,000. Okay. The recoverable amount is 2,000. All right. Now you can see that now the current amount, the recoverable amount is more than the current amount. Okay. The the current amount is now more than it's less than the recoverable amount. So it means there's no impairment. Okay. It means there's no what impairment. So the standard says if an asset has improved in performance and there's no impairment, then we have to reverse that impairment loss. Okay, we have to reverse that impairment loss. And when we are reversing, we have to reverse it to a point the asset would have been if there was no impairment loss in the first place. Okay. Assuming that there was no impairment loss, what would have been the carrying amount? And that's what the standard is saying that when there's a reversal, we should reverse it to a point the asset would have been if there was no impairment loss in the first place. Okay. So assuming there was no impairment loss earlier, what would have been the carrying amount? So if there was no impairment loss in the second year, the carrying amount would have been okay. So the first year the carrying amount was 4,000. Okay. In the second year, if there was no impairment, the carrying amount would have been 4,000 minus 2,000, isn't it? which will give us 2,000. Okay. uh Yeah. So if there was no impairment, okay, we wouldn't have a carrying amount of this 1,005. We would have had a carrying amount of 2,000. So the standard says if there's a reversal of impairment, we should bring it to a point the assets would have been if there was no impairment in the first place. So it means that this 1,500 will be changed to what? 2,000. Do you get it? So it mean we will increase the carrying amount by what? 500. Okay, will increase. So the double entry will be we will debit our assets. That's the carrying amount by 500, and we'll credit our P&L by 500. Okay, to reverse the previous impairment loss. Okay, please, are you with me? Are you here?
Please.
Yes, it's a little bit
So,
confusing, but if you take your time. Mm. So all that the standard is saying is if there's impairment loss will cause the carrying amount to change. Uh, will cause the carrying amount to change going forward. So if there's an improvement in the carrying amount, there's an improvement in the asset performance, and there's no impairment, then we have to restate the carrying amount to the amount it would have been if there was no impairment. So it's like the impairment came to cross the way. I mean, it came to, change things. But if the asset is doing well now, let's go back to where it would have been if there was no impairment in the first place. And that is reversal of impairment. Okay. So that is it for reversal of impairment loss. Okay. So now let's look at a new standard. IAS 20. IAS 20 talks about government grants. Okay, this is a very simple standard. Okay, what is a government grant? I'm sure all of us have come across government grants. Anyone to tell us about government grants? Hello. Okay, what is a grant? What is a grant?
per my understanding, government grant is something given from the government to support individuals or corporations.
Yeah, is correct. Yeah, so government grant is a form of support that the government donates or gives to um, businesses or entities. Okay, and usually government gives grants to certain businesses in certain sectors of the economy, especially if the government want to improve that sector. They will try and help those players in that sector by giving them some grants, like the what's the name, um one district one factory, that scheme. So government can support. Government has an agenda to build a factory in every district. So they will want to help factories in those districts, give them some grants to buy some machines or to build new factories. So that is a government grants. Yeah, and usually there are conditions attached to the grants. So you are giving the grant for a purpose. Okay, you are giving the grant for a particular purpose, right? So, and the one who is going to receive the grant must make sure they are going to use the grant for the intended purpose. Do you get it? Yeah. So when we say government grants, they are assistance, like you said, they are a form of assistance by the government. Okay, in the form of transfer of resources. So the government transfer resources. It can be in the form of money, or it can be in any other form. Any support that will help the company or the business to meet their objectives. So they are assistance by the government in the form of transfer of resources. Okay, and usually there are conditions attached. You have to meet certain conditions. Okay, before you be given that grant. Okay, now let's look at government assistance. Okay, so there's a difference between grants and government assistance. Government grant is resources. You are giving resources. Government assistance is in the form of benefits that is not in monetary terms. Okay, maybe the government can give you a tax incentive, or a tax incentive or tax relief. It is not a monetary benefit. Yes, but it is a form of assistance. You know, yeah. So that's the difference between government grants. A grant is actual resources that government delivers to another party or to an entity, to a business. But an assistance is not, it's not a resource. It's a form of, let me say, it's a form of arrangement that helps the business to, or that gives the business an advantage. I think that's the better word. It's an arrangement the government provides to give certain companies an advantage. So for instance, if the government gives a tax incentive to a certain businesses, it is a form of an advantage, but it is not a grant. It is not a grant. You can't say tax incentive is a grant. No, it's not a grant, but it is an assistance. Do you get it? Okay. So now the main issue is, how do we treat government grants and government assistance in our books as accountants? If we receive government grants, how should we record it as revenue, or should we record it as expense? Should we record it as what? How should we record government grants? Yeah, so that is what this standard is about. Okay, it provides us with guidelines on how we should treat grants in our records. Okay, so there are two types of grants. Let's look at types of grants. There are two types of grants. We have capital grants and revenue grants. What is capital grants? Capital grant is a grant that government gives to entities to purchase non-current assets or to acquire non-current assets. So if the government gives a grant to a business to build a factory or to buy a new machine, to buy a new equipment, that is capital grants. Yes. Then we have revenue grants. Revenue grants, these are grants to take care of day-to-day operations of the business. Okay, so like maybe the government has given grant to pay workers, salary workers. Okay, the government has given grants for you to maybe pay your bills or maybe pay your some of your debts. That is revenue grant. Ehen. So capital grant is to buy capital grant is to buy non-current assets. Revenue grant is to take care of day-to-day operations of the business. All right. So these are the main types of grants. So how do we treat capital grants and revenue grants? Yeah, that is the topic we are going to look at. All right. Now, before you recognize grants in your books, the company must meet certain conditions. So, like I said earlier, grant always comes with conditions. And before you can recognize grants in your books, you must make sure you are going to meet the conditions. So if the government has given you grant to build a new factory, that's the condition. You have to use the money to build the factory. If you know that you will not use the money for the factory, then you shouldn't recognize the grant. Eh, So these are the conditions. Number one, the entity will comply with the conditions attached to the grant. Okay, so you have to you know that you have to comply with the conditions attached to the grant. Okay, the grants, whatever conditions the grant comes with, you have to comply with it. And two, the grant will be received. Like you have reasonable assurance that the grant will be received. It's not like an empty promise, maybe like a political manifesto that we will give every company, every business in this sector a certain amount of money as grants. This not just a political talk, but there's a reasonable assurance that the grants will be received. All right. So if these two conditions are met, then you can recognize the grant. Okay. If these two conditions are not met, then you should not recognize grants. Okay. Okay. Now let's look at treatment of government grant. We are starting with the capital grants. Okay. Now let's use an example, to help us to understand. Okay. Now let's say uh, ABC Limited. Okay. This ABC Limited um is into cocoa processing. Okay, they set up factories in remote areas to process cocoa, and the government want to help them, and the government want them to build more factories. So the government has given them a grant of um maybe 1 million cedis, okay, to support them to build a factory at a particular location. Okay. Now the company has received a grant. The company received a grant on 1st January 2023. Okay. The money has hit their account. Okay. So what do you think will be the first double entry? Okay. The company has received a grant in their account. How will we record this grant in our financial system? Anyone to help? What will be the debit and the credit? Hello.
So you debit you debit the asset account, then you credit the grant.
Okay, so you debit your bank. The money has hit your bank, isn't
Yeah,
it? So 100,000.
yeah, yeah.
Then the left with the credit side. Yeah. So the credit side,
Yes.
you know,
That would be
that will be the grant. Yeah. But we call it deferred income. Okay.
okay.
Yeah, because we have not used the money yet. It's we are going to use this later. So that's why we are using deferred. Okay.
Okay.
Yeah. So you debit your bank like this, deferred income. Good. Okay. Now we have used the grants. We've been able to build a factory. Okay. And the factory is exactly 1 million. Okay. The factory is exactly 1 million. So it means we will debit our property or the factory. But the factory is a property, so it's a PPE. So we'll debit it by 1 million. Then we'll credit our bank because we use the money in the bank to build the. We use the money in the bank. This money we have used everything to build the. So it's just like we are transferring the money from the bank to the what is the name, to the property. Do you get it?
Yes, please.
Mm. Okay, so now we have built the factory. Okay, and we use the grant to what? Build the factory. Now this factory has a useful life of maybe 10 years. Okay. This factory has a useful life of 10 years. It means every year we have to depreciate this building. Okay. You have to depreciate this building by 10 years. Okay. So what will be the depreciation for year one? So that will be 10
It
million.
will be
Okay. How much will it be? So that will be
100,000.
100,000. So every year we are going to depreciate the building by 100,000. Okay, good. Now remember that when we received a grant, we recognize a deferred income of 1 million. You get it? So this 1 million is still sitting in our deferred income. We have not used it, but the building is completed. So we have to clear this money. Ehen. But what happens is we don't clear the money at once. Okay, what we do is we will amortize the money based on the useful life of the assets that the money was used for. Okay, so every year we will amortize the money. We will amortize the what's the name? The deferred income. Do you get it? So as we are depreciating the assets by 100,000, then we'll come and amortize um the grant. So when we say we are amortizing, it's like we are dividing the grant in pieces. Every month, every year, we will spend some of the grants, and that's what we are trying to mean. Every month, we will spend some of the grants. Uh, okay, so let me make it clearer. So now we have a factory. The cost of the factory is 1 million, and we were given a grant of what 1 million, and the useful life of this factory is 10 years. Okay, now let's look at the double entry. Okay, this is a very simple double entry. We will debit our PP by 1 million, then the deferred income by 1 million. Okay, like this. Now every year we will depreciate these assets. Okay, and when we depreciate this asset, we also have to amortize this grants. Okay, so year one. So year one, what will be the carrying amount of the assets? Okay, the cost is 1 million.
And
Yeah, and the depreciation is 100,000, right? Yeah, 100,000.
yes, please.
So what will be the carrying amount of the? That will be 900,000.
Now,
That's year one. Okay, correct. That's for the asset. Then you do the same for the grant. You see, the grant to um the opening balance is 1 million. Then we amortize instead of depreciation, we call it amortize. Okay. It will also be 100,000. Then the balance will be what 900,000. Okay, like this. So in our balance sheet, okay, we will show the grants as 900,000, and then the assets will also show 900,000. And this will go to the income statement. This one, this and this. This will be the depreciation, and this will be the grant income. Okay. When we go to the second year, we'll do the same thing. Okay. So by the end of the 10th year, the last year, then we have used all the grants, and we have also depreciated the whole asset. So at the end of the 10th year, the asset will be zero. The grant will also be what? Zero. Do you get it? Do you get the idea? Hello, Gideon, are you there? Hi. Hi. Hello.
Hi.
Okay. Please, are you okay?
Yeah, we're okay.
Okay. Okay, that's fine. Okay, so that's how we that's how we treat government grants. So let's look at another example. So let's say we have a capital grant. Okay, we use it to build we use it to purchase an equipment. Okay. Okay. So the cost of the equipment is maybe 150,000, and we receive a grant of um maybe 80,000. Okay, the grant we receive is 80,000. And the useful life of this equipment is 5 years. Okay. So it means that every year, so it means the double entry will be like this. Um the equipment. You debit the equipment of 150,000, then the grant as deferred income. It will be in the balance sheet. Okay. Hey, what am I? Okay, 80,000. So it means that the company used its own money to pay the rest. So bank 70,000. Okay. Okay. The cost of the equipment is 150. The company received a grant of 80,000, and they use their money to top up. Okay. So it means this is a grant. That's what we are interested in. Okay. So every year we have to amortize the grant. We also have to depreciate the assets. Okay. So year one, okay, we need to find the current amount. So the current amount, the cost is 150,000. The depreciation is how much? That's 150 divided by 5. That's 30,000, right? And this will be 120,000. Then we come to the grants. Okay. The opening balance is 80,000. So amortization is 80,000 divided by 5. So 80,000 divided by 5. So how much will we get? 80,000 divided by
You
5.
get 80,000
80,000
by
divided by
5.
5. That will be 16,000.
Over 16,000.
Uh-huh. So the closing balance will be
That's correct.
64,000. Uh-huh. So in the balance sheet, in your balance sheet, That's what will happen. So you recognize the equipment at 120,000. It's the equipment and the assets 120,000. So this is assets. Then the grant will be under liabilities. Okay. We recognize what deferred income of how much? 64,000. Do you get it? Are you okay? Hello, are you okay?
I follow you.
Okay, yes. So this is how it will look like. Then the following year to amortize it. So the following year this will reduce by the 16,000. Every year is 16,000. So the following year minus 16,000.
16,000.
This one too minus 30,000 until and zero here. Do you get it? So that is how we
Okay.
treat capital grants. So the grant is recognized as deferred income, and every year we amortize the grant. Okay, based on the useful life of the assets the grant was used for. Yes. So if the useful life of the asset is 2 years, then we'll amortize the grant over 2 years. If the useful life of the asset is three
2 years.
years, we'll amortize the grant over 3 years. Yes. Yeah. So that is government grant. So we'll end here and we'll continue tomorrow. Right, we'll finish it and we will solve some past questions on it. Government grant is very
Okay.
popular. It always comes in ICA and financial reporting. So
Oh,
you must understand it. It is always examined. Yeah. Okay. So on this note, Gideon will end here and we'll continue.
so